We have the combination of quite weak fundamentals in Europe at the moment. As you say, the biggest economies effectively stalling, Italy in recession, but at the same time, a host of uncertainties relating to politics. Brexit coming up, as you say, with still no very clear sign about how that may evolve. We have upcoming elections in Europe this year, 10 formal elections. We have the European elections and some big changes in major roles in Europe. The ECB head leaving in October, the head of the European Commission and Parliament as well. So a lot to play for this year.
Yeah, and what do you think is the most important thing? What's the biggest possible outcome? What's the biggest possible risk right now?
Well, strange enough, right now, I think a lot of the weakness that we're seeing in Europe itself is partly a function of what's happening outside of Europe. You spoke earlier on the programme, of course, about the developments in terms of world trade, the conflict on trade between the US and Europe and China, which is having a detrimental effect on Europe as well, particularly those countries which are very dependent on exports. Germany is a very important point in case. So that's one of the immediate and most important things that's happening. Of course, from a domestic perspective, what we see in the UK will be crucial. If there were a crash out of the EU with no agreement at all, that would be bad news for the economies, both in the UK and the rest of Europe. But more systemically, I think also you have the issues of growing populism in Europe, which may be reflected in the European elections, and also issues relating to, for example, the Italian budget.
Yeah.
But right now, actually, Europe is most focused on, from an economic perspective, really on global factors, which could have an important bearing on whether we get any recovery in activity over the remainder of the year.
You know, and here's, I guess, the interesting part. When you look back at history, sometimes you realize, you know, it's darkest just before the dawn, that when things seem the worst is when you should have been buying. Now, hindsight is fantastic, right, Peter? But there's so many negative headlines, whether it's Italy, Deutsche Bank, trade, the growth, whatever you just talked about them. Is now the time to buy European stocks because everything does look so bad?
Well, it's important, you make a very good point, and it is important to emphasize that the European stock markets are not really the European economies. They're two different things, and the main companies, the biggest companies that make up, for example, the Eurostoxx 50 or the Stocks 600, are quite global in exposure, and they tend to be in very global industries. So they are impacted by what's happening not just in the domestic economies, but what's happening worldwide. They tend to be in more cyclical sectors, so in a sense they're more operationally levered, more high beta than most other markets. And we should bear in mind that European stock markets have enjoyed a rally over the course of this year to date, just as most others have as well. But fundamentally, that said, we do think profit growth is going to be pretty weak this year in Europe at about 4% growth. It's worth noting that we expect pretty weak profit growth across all major regions this year. And with valuations now, we think roughly sustainable at these levels, that means we're going to get pretty low returns, driven by modest but positive profit growth. And that's where we get this idea of a sort of skinny and flat market, relatively low returns in a reasonably narrow trading range.
Yeah, that's why you said, and we led the show with it, think skinny. Have all the gains or most of the gains for the year, in, I know it's only, what, February 7th or whatever it is, have all the gains already been made?
Yeah. Largely, I think, yes. At the beginning of this year, we argued that we felt the markets had overpriced recession globally and valuations had fallen too far. But we argued that if the markets began to rally as inflation risks started to moderate, you needed to be invested, because if you missed it, you probably missed most of the returns for the year. And I think, you know, a month and a bit on from that, it's probably pretty true. You know, we've seen a lot of those recessionary risks now priced out of markets, prompted in part by the much more dovish tone from the ECB, from the Fed and others. But now, backed by relatively modest profit growth, we would see only reasonably small increases in total price returns from here. So in the case of Europe, for example, if we take the stock 600, which we focus on as an index, we're looking at 375 for the end of this year. That's about 3 or 4% from where we are now in price terms. Remember, there's a reasonable dividend on top of that, dividend yield of 4%.
Yeah.
So total returns in the sort of, around 7% or so from here would be what we would be expecting.
Before we let you go, I want to throw you a little bit of a curveball here, because I'm sure it's maybe out of your wheelhouse, but I got to ask. I'm sure you've been following the political developments here. We're talking about, some of the Democrats have hit on, and I don't want to make it a political statement. It's about maybe the war on wealth, right? We're talking about 70% tax rates. Some of the presidential candidates talking about tax rates going up on 10 million and plus in net worth, dividends perhaps, or buybacks being taxed more somehow by Chuck Schumer and Bernie Sanders. Is there kind of I don't want to say black swan, because we're obviously talking about it. Is there a market risk to some of the political idealism that's going on in the United States right now?
Well, I think the comments you make about the United States are not unique to the US. We're seeing similar forms of political rhetoric in many parts of the world, including Europe. And generally speaking, we're getting politics moving away from the centre ground, reflecting, in a sense, this rising populism. Some people would focus on the fact that, wages have not moved very much at all since the financial crisis in most regions. Financial assets have benefited generally from years of falling interest rates and QE. And that's sort of feeding, in a sense, this growing uncertainty, which is voiced and reflected in populism. How does that feed into markets? Well, most importantly, I think these are things that are difficult to forecast and model, and therefore they're reflected in things like risk premia. In other words, all else equal, these uncertainties just keep valuations somewhat lower than they might otherwise be, or the gap between valuations and equities and bonds needs to be wider. You need higher dividend yields, lower multiples to reflect these sorts of uncertainties. And that's another reason why we think that although the fundamentals are not as bad as people feared at the end of last year, we're not likely to see recessions. We think the upside for equity markets, now we've seen this rally, is relatively limited.